Welcome to the Mind Your Business podcast, the podcast that goes straight to the core of what drives entrepreneurial success. I'm your host, Max Fortune, and with over 30 years of experience building businesses and guiding others to do the same, each week we explore the mindset, strategies, and real-life stories that distinguish thriving entrepreneurs, delivering candid insights that you need to elevate your business and to reach new heights. So if you've tuned in and received just one piece of advice that you can use to make your business journey a little easier, make sure you like, follow, and subscribe to Mind Your Biz Expert on YouTube or whatever platform you're watching or listening to this podcast on. It's just a little thing, but it goes a long way to keep the podcast going. So just pause now and just do it. All right. Today, I'm joined by Amun, and I'm really excited about this conversation. He's the founder and managing director of Valken Holdings, LLC. It's a capital advisory and strategic consulting firm focused on mergers and acquisitions, capital formation, and enterprise transformation across fintech, healthcare, energy, and emerging industries. Now, this guy's got over 25 years of experience. That's a lot of experience across Fortune-level organizations and global integration leadership. Alan has major acquisition integrations involving companies like Humana, McKesson, Change Healthcare, Rico, SunTrust Bank, and Walmart Health. So you want to listen to this guy. He's a certified merger and acquisition advisor and has overseen enterprise programs exceeding $50 million in scope. So, Alan, welcome to the show.
Well, thank you, Max. Thank you for having me. It's a pleasure to be here and an honor.
All right. Thanks. Like I said, thanks for, it's the honors are going to be all ours. I'm sure we're going to get into this. But before we dive into our conversation with Alan Amun, let's set the stage with our Mindset Minute. Now, this is where we take a moment to focus on a powerful nugget of wisdom designed to help you push through the challenges of the week. Now, it's a quick mental reset to keep you sharp, motivated, and ready to tackle whatever comes your way. So let's get into it. Entrepreneurs, I want you to focus on revenue. Our institutions focus on valuation. There's a difference. Okay, I'm sorry, I'm going to do this again. Entrepreneurs focus on revenue. Institutions focus on valuation. There's a difference. Revenue feeds lifestyle. Enterprise value builds legacy. This week's shift, stop asking, how do I grow? Start asking, how do I become investable? Now, let's talk about that and what that actually means. How do people become investable?
So that's a great question, and I think that's where a lot of entrepreneurs should start. Although, and I'll kind of maybe frame it up this way. What I tend to experience between what I would say an entrepreneur and a dreamer. So most people go into their business looking at, how do I fulfill my dream? They're not looking at it from a strategic point of view. So how do you become investable? Well, I always say, look at yourself as the investor more than the person looking for the capital. Does this look like an opportunity that looks like it has value? Is it something that's going to grow? Is it something that you would infuse $2 million, $6 million, $12 million, $20 million into? And if you as the investor would have concerns or questions about that, then how do we alleviate those concerns or questions, right? So that process typically goes through looking at developing what we call a data room. And in that data room, you have several folders, and those folders may have the business plan, the business roadmap in terms of where the business is currently and where it is projected to go in the next 5 or 6 years, as well as the pro forma, which is a financial document that basically states what the business has been performing at over the last 6 years. And then as well as a growth revenue model in terms of where that business is projected financially to grow in another 6 years, so to speak, as well as any assets that you may have on hand. So if that asset is an intellectual property, if it's brick and mortar, if it's software in terms of another form of IP or intellectual property, those are the things that we want to take into account and put together and format and put into the data room and go over those artifacts and say, if I were an investor reviewing the data room, does this look like a stable investment for me to participate in?
So it's like taking yourself out of self and kind of stepping across the room and thinking like how an investor would look at that same, or kind of like looking at your business from a different point of view, not just from the point of view that you always look at it.
Exactly.
Because again, the viewpoint could be and usually is different when you kind of take yourself out of it.
Right. It's almost asking yourself, would you date you? I mean, and most people would say, hey, yeah, I'm a great person. I've got all these qualities. But again, it's an investment, right?
Right,
So
right.
for an investor, they're looking at it from a standpoint of, I want to be able to invest in something that I know my money's going to grow in or my investment's going to grow in. But aside of that as well, can I do business with this person?
Mm.
And a lot of times, what I normally get is someone saying, okay, I might want equity or debt. So that's someone who may, um, from an equity standpoint, want 15, 20% of the company. And then they'll say, well, I wanted them to be a silent equity partner. And I don't always advise that
Okay.
because the person that you're choosing to be an equity partner may be someone who is strategically placed in your industry.
Mm.
They may have a lot of relationships, and ideally, that's who you want to partner with. And they may have a lot of knowledge, and
Right.
then they may have a lot of connections. And at that point, that person becomes an asset to your business.
Mm. Hmm.
And so they're able to help your business grow. They may be on your board of directors or advisors, and they're an asset and help you to be able to scale and grow that business. And then, of course, there is silent where they may want to do an infusion and may not participate from a governance or day-to-day standpoint. And then you want to be able to evaluate how you want to structure that up. So to me, you're always looking at, as a business owner, from the standpoint of what would I be doing if I were an investor in my business?
I want to kind of have you kind of walk back a little bit, not walk back, but take us back to something. You just said something really important, I think. You said there's kind of like two evaluations, equity and debt. And
Correct.
so I don't know that people think about sometimes that some investors look for debt. So kind of, can you speak to that just a little bit? I just wanted you to kind of.
So debt is essentially, like any other form of debt, like a credit card or something of that nature, where you can go to the SBA or an institutional capital. If you're, have strong assets or strong cash flow, then you might say, I want to be able to get an infusion of $10 million in my business, and that'll help me to grow my business. I'm already profitable. I've got great revenue and significant margins, and so I need to do what some may refer to as an add-on. I mean, I need to add on another stream or another offering into my business, and so I need to raise $10 million for that. And so, and what we would consider to be a classic institution or an institutional bank, such as Bank of America or Truist, which was formerly SunTrust, may look at that opportunity and look to invest in it. And they're not going to want an equity or a percentage or stocks or shares in the company, but they'll maybe want for that $10 million, 6%, 3 to 6% return over 5 or 6 years or whatever that option looks like. And so that's typically a debt play. That's typically a debt structure. And typically for a debt structure, you want to be, as stated, have an asset on hand, your revenue or your EBITDA, positive flowing and that sort of thing. There are other instruments out there. There are various sorts of instruments for debt. There's factor lending, something that sometimes people will use to make payroll if they're having some issues or concerns. That tends to be kind of a high interest debt loan or mezzanine. And so there's a lot of different offerings out there, but typically when I would position debt for somebody, it would be to expand and grow their business. And again, if they have great assets and great cash flow, then I would position debt.
Gotcha. And so you know what, and I'm going to probably work a little bit of this in here. So one of the things that I specialize in is in business credit, helping people kind of get ready for business
for that
capital.
event.
And I wanted you to talk about being transaction ready. I think sometimes people don't think about being transaction ready, and what does that actually mean? So can you kind of go through that?
Transaction from a standpoint of
being, I guess, ready to be purchased or repurchased.
Oh yeah, certainly. So having done buy side and sell side representation. So again, that goes back to having a stable data room, right? And saying, okay, if I want to sell my company, and this goes into what is known as exit planning or exit strategy, and also being a certified exit planner as well, which is one of the things that I've taking an education on, is that essentially looking at your business and saying, okay, I've been in business for 20 years. I want to be able to exit out of that business. And maybe kind of give some background on this. So most people don't realize that most businesses do not go legacy. So most businesses, might be 20 to 30 years in your business. The percentages of businesses that go legacy, meaning second to third generation, is roughly about 3%.
Wow.
So mostly the children are the inheritors of, typically don't want to continue in that business. Sometimes they become ESOPs, which is where the employees will buy the business and it'll carry on that way. But less than 3% tend to go legacy.
Wow.
So with that being said, you have to look and say, well, how do I want to exit out of this business, right? So one of the things that I initially have to relate to that founder or entrepreneur is to say that your business isn't your child. So we need to move from that direction. I know you've had your business for 20, 25, 30 years. You're close to it, but this is a product or service that you've developed that has been able to provide a living for you and your family, and now you need to be able to exit out of it. So how do we do that? And we need to be able to do that through strategic and logical means. And so that would be to be able to do, first and foremost, is evaluation. So evaluation is be able to, what the market and your industry is saying, what your business is worth. Now, you could state that your business is worth $30 million, but the market may say it's worth $40 million, or the market may say it's worth $20 million or $18 million, or whatever it is, right? So we need to be able to assess that. We need to be able to go to a certified valuation and then get a valuation for your business, a market analysis. And then we also need to be able to see what's the best methodology for you to be able to exit out of your business. So be able to look at potential buyers within your industry and then say, okay, would they buy the business in its entirety? Or would they might only want to buy sections of your business? That's a lot of things that people don't realize.
Right.
So they may think that someone may want to come in and buy the whole business, but they just maybe want to buy a particular particular business unit or customer base, or we have to evaluate that because your business, you may look at it and think that there's a lot of assets on it, but in someone else's purview, there may be a lot of liability and debt. Case in point, a lot of technology or hardware, there's not a lot of value in hardware. So a lot of companies may say, hey, we don't want to take this portion of the business because then we've got to dispose of this or decommission it, and that's a cost, right? But you have a great customer base. You may have other technology or software that they may find valuable, and so they may just want to kind of take portions of that business. And then in addition, you yourself may be the primary asset. So as a person having the relationships in that industry, knowing, the process and strategy that you've put in place, so they may look at and say, hey, we want roadmaps or processes, methods and procedures or standard operating procedures that they would want you to develop in terms of that transaction. And then being ready to put that forward and then being ready to possibly stay on 2 to 3 years. And then transition out of it. So
I have that begs another great question, and I don't know if how often people I always think, even in business, and I don't know how many people think this way, but you really kind of should begin with the end in mind.
Yes, definitely.
I don't know how many people do that. Kind of go in thinking about, okay, I want to build this thing, and at some point, you're going to want to exit, or you should be thinking about that. And if you kind of go in with that, I think you kind of build it differently.
Right.
If you're going in with the end in mind. And actually everything you're saying is kind of speaking to that after the fact. And I think so many people kind of think about that after the fact when they should kind of go in, because I think if you go in with that, you create systems, you create a lot of things, and you would make it so that your business is not depending on you as the entrepreneur. And that, because again, that I would imagine that also leads to a higher valuation if you are not the center. And what people need to do is if you're not running it,
No, Max, I think you're touching on something that's really important to talk about. So, and I see this with a lot of beginning entrepreneurs, and then being able to kind of have a perspective from an SMB or small, medium-sized business, and then working with so many large-scale enterprises, I notice a difference in methodology. And what I'll say to that is that a lot of small, medium-sized business people, they look at their business as a vehicle to, of course, as I stated, live out their dreams, and then a vehicle to basically, I guess there's no other way to say it. Most businesses that I've seen that have become highly successful are not pretty. They're not quote unquote exciting. They're not something that you're going to see on social media or things of that nature. They're very method based, very methodological, right? So to your point, when you're getting ready to start that business, or if you've started the business and you want to grow in it, there's a method to that, and you have to be very strategic about how you're going to get to point A, point C, and then to point Z in terms of how you want to exit out of that business. That's market analysis. That's being able to understand what a private equity company may want to acquire, right? What's attractive. As an example, right now, a lot of HVAC companies are very big in the private equity space, and a lot of reason for that is because they tend to have a lot of large market share. So if they're in a particular subdivision, they may be servicing 300 homes. How many times do you change your HVAC guy, right?
Yeah.
So that's a consistent amount of revenue, and then in terms of kind of using that as a business case, and then their expansion model is to go into areas and that they may look for new subdivisions. We don't think about it because we're not in that business, but these guys are literally driving around looking to see where new subdivisions are being built so they can expand their business model. So they may have a book of business of 500 to 1,000 clients. A private equity company is going to look at that. They're going to see that they're servicing that. They may also have some relationships with some manufacturers for parts and services.
Right.
So that's a great revenue model. That's a great means to be able to exit out of that. And private equity would tie that up with another company and probably create a larger company and then inevitably sell that off. And so that's, as a business owner, how I would think.
Gotcha. So let me ask you, what are investors like quietly evaluating that founders don't realize?
What are they quietly evaluating that founders
You kind of touched on some of this stuff here. But I think sometimes as founders or business owners don't think about some of the things that investors think about, what the investors care about.
The founder.
Okay.
So I'll give you a real world scenario, and I won't, the names will be changed to protect the innocent.
Okay.
We had a client, great idea, great piece of software, did some, great demographic work, and we had a very large company that wanted to invest in it. They were going to bring $10 million to the opportunity. Did a lot of great media development for them on YouTube and in different other platforms, social media platforms. Coached them on the appropriate interactions. And we got to third base rather. I'm getting my sports analogies mixed up. We got to third base, almost home, and the founder was saying that he had developed this particular platform predominantly for small businesses, and that's where he wanted to see it rolled out and things of that nature. And then the investor, which was a very large conglomerate, wanted to deploy it in about 2,000 units and see how it worked. And the founder wasn't making that leap, if you will. And long and short of it is that we weren't able to close that deal because the investor didn't feel like they could work with the founder. So that is very important that, you're not always going, and what I call Disney money is money where people think someone is going to give them 10, 20, $30 million. And the investor is not going to have any buy-in on that.
Right.
And you have to be someone that an investor feels like that they can partner with, and that you're willing to be able to not necessarily, forego your principles or ideal, what your initial thought was, but you're going to be able to also fit into their vision and their concepts and their dreams, and kind of closing that out. One of the things after the fact, what I was trying to get that founder to realize is that, this is a larger conglomerate. They have the money, more than likely, your product would have been picked up, and you might have either sold it, and they would have ran with it, or you might have had an equity infusion, but you could have developed another product for that small and medium sized business that you initially looked to develop this product for. So you also have to have a long term thinking that may not necessarily be what you were initially thinking, but bringing on that investor, working with that investor, looking at that opportunity, and then being able to pivot or adjust, for the goal that you may have originally looked to plan for.
Gotcha. So, with our audience, the people that we usually watch our podcasts are business owners who are starting a business,
Yes, sir.
or they're trying to grow their existing business, or they're scaling their operation. And so, in your opinion, Alan, at what stage should a company start kind of preparing for an exit?
Oh wow! When they should start preparing for an exit, well, several. When you no longer love it,
Okay, that's one.
love it or like it. Look at the market. Observe the market. I think a lot of times, and I get it. When I talk with founders, they get you're doing your job, and that's what you come in every day to do, right? So you're not out there looking at the market. You're not looking and see if just like any market, you're not seeing if the market is up or down. And when you're approaching that exit standpoint, you need to kind of be able to look at where the market is in your industry, right? And if this is the right time for you to be able to get the most value, and if it's not the right time to get the most value, then you still may sell,
Right.
but you may not necessarily sell all the way out. You may want to hold an equity position. So there's ways to be able to
that's a good
structure that
That's a
up,
good point.
right? You could still be able to hold an equity position. And then also you may also want to look and say, how do I make my business more attractive? Before exiting, you may want to do an acquisition yourself, which will bring more value to your concern, your business, and then that may increase value in your business. So you may want to do an acquisition, increase that value, and then 5 years down the line, you can estimate that you may be out at 10, 12x.
And going back to what we were saying earlier, as part of that whole beginning with the end in mind, but that's a great point that you just mentioned, because sometimes it's the difference between a larger deal, that last minute acquisition, or something that pairs well with what you have. So no, I think that's a really, really great idea. And this is something that people just don't naturally think about all the time.
Right.
Is how can they pair with someone? How can they partner with someone that has a similar goal, or understand, hey, this is where we're trying to get to this place, and hopefully they're at the same stage, or maybe they want to stay on, but you were ready to exit out, and it makes sense. So it can make sense from a lot of things. So what would you say is we're kind of talking about a little bit of stuff, but the biggest misconception founders have about M&A, like what would you say? You kind of touching on some of the stuff with mergers and acquisitions. It's
Right.
like what are you kind of finding out there?
Can I be blunt?
Yeah, yeah.
That
Please.
someone wants what you have.
Yeah.
And what I mean by that, and I don't mean that in the negative. Again, it's what you said. I'm going to kind of go back to what you said. You have to look and look at your exit, right? So if you're at that 18-year mark, and you know that you want to exit out, at the 25-year mark, right? You have to start developing your business into something that someone wants to buy.
Right.
And it's difficult.
Right.
It's very difficult because you're running your business.
Right.
So you're running the day-to-day operations of that. You've been good at it. You've made it profitable. You've kind of gone through the different steps. So it's hard to do that. A lot of times you can, go out and hire someone like myself or consultancy firms that can help you to do that. But however you approach that, you need to, I would say, 6 years before that exit, you need to start planning that exit. You need to start looking at, and you've got to realize from the market's point of view, not from your point of view, is this something that, a buyer, private equity, someone may be in a business very similar to yours, and, as an example, there's a lot of people don't know this, but there's companies that make mats and industrial mats.
Okay.
And great business, by the way, great margin in that business. But there's not a lot of competition because most people don't think about making mats, right? Commercial or industrial mats. Um, but for that industry, if you've got market share and your market share is the Southeast, and you've been able to service those customers for 20, 25, 30 years, then someone's going to want to buy you, right? So the question is that from my standpoint, the first thing that I would look at is how do I make that attractive? Well, in that industry, I would look at ordering and logistics.
Okay.
Is my ordering and logistics operational area, is it solid? Because the backbone to that business is, being able to get that product there on time consistently. So if I built a model that, I'm able to fulfill orders, be able to get them to the various clients that I have in a timely manner, in a consistent manner, then that's attractive. That's a value add to somebody in that industry, right? And then having that customer base and having that loyal customer base, then people are going to come to you because they're going to see. Today, no one wants to grow organically anymore. So our grassroots, if you will, that is hard to do and expensive in modern markets, right? So most people want to grow through acquisition. So you have to develop your business as something that's attractive to a potential buyer, private equity, another large scale buyer that is going to say that's a profitable organization. That's the target that I'm looking for. So how do I go in? And it also puts you in better negotiating position, by the way.
Yeah. And so you're saying, what I'm hearing you say is that it's good to do some self-evaluation, or especially if you're thinking about exiting, or really even if you're not, because at some point you will. So it's probably doing that assessment and kind of thinking about processes, systems. How can you make things better? How can you streamline this, or just, I guess, build a better mousetrap or whatever you're doing? And so I think that's what I'm hearing. It's kind of like good self-assessment.
Remove as much difficulty or roadblocks as you can, right? And again, and streamline, cost.
Yeah.
You don't want, to show that you have a lot of overhead. You want to be able to show that you've built a really good mousetrap, that if you walk away in 2 years, that machine that you've built, will continue to work without you being there. And so that's a seamless integration for that particular acquirer, right? So that's what's attractive. And again, a lot of people get stuck on things like infrastructure, but in modern day society, infrastructure is really easy to overcome. It's the system that really is the part that makes or breaks a lot of things.
And, I don't know how many people really put as much focus on the system of how things get done, because sometimes you kind of start a business and you're learning that as you go along. You're kind of putting together, kind of figuring out, and then you get used to doing what you've been doing.
Precisely.
And never coming back and assessing, can this be done better? Can this be done differently? Who's doing it differently? Who's doing it better? So all those things just are great things to kind of just, I guess, assess or to think about. I think even if you're not thinking about selling your business today, I think any business owner, anybody who's out there listening to this, should be thinking about their systems. Would you agree with that?
Yeah, definitely. I think that's the backbone is creating, a great system. And the opposite side of that, and I'll just, for the sake of conversation, is turnarounds. Where you do maybe have someone who has a great asset, they have a good hard line brick and mortar or a lot of a great book of business, but their system was terrible, right? So then an acquirer may want to, invest or acquire them because of the assets that are on hand.
Gotcha.
And then they would hire someone to be able to do a turnaround. And then that turnaround is where you typically remove all the C-level staff and you bring in new C-level staff. You bring in new CEO, CIO, COO, and that sort of thing, and you turn it around based on what's in there, and then it becomes a valuable scenario. But most of the time, most investors are looking for a solid system.
Wow. So those are things that kind of, I guess, increase value in your valuation. So what are some of the red flags that what What are some of the things that I guess investors look
Well,
at?
I'll go back to a comment that you said, and a little earlier, doing it all yourself.
Mm,
So I really dissuade people from being the one point, because there's one point to choke, right? So from their perspective, well, I've been able to do it all myself, and I can understand that from where they're standing, right? But from an investor's perspective, that's a concern, that's a risk, right? Because as you stated, it hasn't been disseminated out, or there's not a model in place to be able to build upon our streamline. And so you need to be able to create a model that, a potential investor can streamline or grow or be able to pivot on. The other portion also is carrying too much debt. So a few years back, a lot of people took the PPP loan?
Yep.
Right, and it was a real rough time for a lot of people to get money.
Right.
Because the structure that is that you're looking at there is if the SBA, a particular bank, is the first right of refusal. So if something happens, they're going to be the first person to be able to, basically demand their money back or liquidate assets or something of that nature. So you want to make sure that you're able to maintain and manage your debt, to be able to acquire capital, and that you don't let that become a roadblock for you. And the other thing I always stress is having an asset. Even if that asset is buying a warehouse, and you've got
And
a good
speak to that. Explain what that is. Like you're talking about like a physical asset,
brick and mortar
Okay.
asset. If you're a software company and you own the IP, that's a little different. And a lot of software companies don't own their IP, but they think they do. Because if they use open source software, then there's a conflict of interest there, right? But brick and mortar. So as an example, I had a client and they were doing a lot of plumbing. And they had a lot of great government contracts. They were 8A, and I said, be a great idea if you got a warehouse. It's like, oh, well, we don't, just get a warehouse anyway. And, they went out and they bought a warehouse of about 1.2, and, they bought it in an area. They already had a good amount of equity in it. I think they had already had like 300 or 400,000, because they bought it at a good price. And then the other thing that I suggested to them is you take a portion of the warehouse for your business, and then you take the other portion of the warehouse, you get a dividing wall, and you rent that out. You can rent it out to a logistics company, trucking, or other offices and things of that nature. So what am I reflecting here? One, you have another form of revenue generation, right? And then you have an asset that you own, and it has equity on it. Banks love that. They love to see that because it shows them, and you're in one place. You have a solid location.
Right.
So they love to see that. That's hitting all of their boxes.
Gotcha. No, that's important to know.
Yes.
That's like I said. These are things that are just great little things that people don't kind of think about, but they're difference makers. And you know what? You have a lot of experience, 25 years in this thing. You've led some global integrations. In your mind, like what are some of the things that might destroy the value of a business, like post acquisition, like after it's acquired? What are some of those kind of things that you've seen or have experienced?
So knowing how to transition. So typically after an acquisition is done, you have what's called a transition service agreement, or a TSA, which outlines how all the transition should go. And you'll see this more on the enterprise level, but I believe everyone should still put one in place. And the reason for that is that it's a marriage. So when you're buying another company, it's like, you're getting married. And, after the honeymoon is over, the reality is there, right? So as the saying goes, most people plan their wedding better than they plan their marriage. So, you want to be able to plan that transition and that acquisition well, right? So as an acquirer, you want to know what is the revenue generator, what are you really buying, right? And then if there are some stipulations where you may have to keep on certain human resources, because sometimes that's the case, and being able to transfer those people over appropriately, being able to develop those methods and procedures instead and operating procedures. What I see a lot of times in transitions that cause failures is that people get scared. The acquired company, the company that's folding into the parent company, those people tend to get a little scared, right? And so the concern is am I going to have a job 6 months, a year, 2 years from now, right? So they start developing towers. And then, within their group, and then they start holding information. They start holding, processes and procedures. If I'm called in to do a transaction, the first thing that I do is I stop that, I dissuade that, I identify it, and I stop it, because it ends up making that transition longer than it needs to be, and it also ends up reducing our time to be able to start generating revenue, especially if it's from a private equity standpoint. They want to be able to produce revenue as quickly as possible. So I say that to say is that you have to bring somebody in who doesn't have a dog in the fight from either the acquirer's position or the acquired position. From that, and not that I'm tooting my own horn here, but I believe that you should always get an external company for that. Someone that doesn't have an interest from this side or that side, and looking at it, completely, in terms of the transaction itself,
right?
And starts taking those steps to be able to bring that company into the business unit for which they've been acquired. At the same time, understanding and appreciating that you have to also bring human beings into a new culture and a new methodology. But if you don't do that from the offset, I can think of multiple enterprise companies that I've worked with that we'll put it like this. I know one transaction that I did cost $50 million. Well, a little more than that, actually. My number's off. It cost about $130 million because they didn't do that transaction properly. Wow. And they left it in the hands of the acquired company. The acquired company and their members started to kind of form towers. They drug their feet. They couldn't IPO in the time that they needed to IPO, and essentially lost about $130 million on the initial IPO. If I would have had full reign over it, it wouldn't have went that way. But anyway.
Wow. And so you're kind of touching on the next question I was going to ask you was, in your mind, like how important is operational alignment versus financial performance, and sometimes those things can conflict or be challenging.
That is a great question, and thank you, Max, for that, because I believe operational alignment is key. A lot of times when you have a company that is acquiring another company, especially on the enterprise level, the first thing there is, okay, we want to generate revenue, and I get it, because otherwise it's like a car sitting on a lot, right? It's not making any money, and so it's debt. But operational alignment is so key, because if you're not, if you don't have that down, year and a half, whatever, or as I stated earlier, it ends up dragging out. Now you're, losing money, right? So you need to be able to set the standard on the outset. You need to be able to, establish those KPIs or key performance indicators on the outset. And so for me, working with the operational team is where I like to start. And then being able to understand, okay, where's the OpEx side and where's the CapEx side, and how do we stabilize both and move those forward and be able to get those both moving out the gate well, so we don't have a slowdown or an issue in that regard.
Wow. So, that's important. It sounds like a lot of strategy has to go in place with a lot of the stuff, and people should be thinking strategically when it comes to all this stuff, kind of coming on, selling, acquiring something else. What kind of separates like a successful capital raise from like a failed one? Like what are some of the things that you've seen in that department or in that?
Excuse me. Again, having your information together, right? Having your data room together, being able to show value, and also something I haven't talked about a lot, but being able to tell a good story. So you have to get that investor. Again, I use the adage that no one's investing into your dream, and there's truth to that. But on the other end of it is that I think people will invest in your story. And there's a difference.
Okay.
And so, the story is that this is where I started, this is where I'm at, and this is where I want to go. And this is my journey to get there. And this is why I have been successful, and this is why working with me, we'll be successful together. And I think because again, it's not just them interviewing you, but you're interviewing them.
Correct.
So it's a partnership. And so you need to understand their story, and they need to understand your story. So a big part of that is telling a great story and bringing them into that story and bringing them into that partnership. And then, of course, having, your portfolio, your SIM, or customer information memorandum, your pitch deck together. Those are to be able to show where you're at, where you're going, and have your data room together. And then also having your team together, an advisor, a lawyer, an accountant, and having those parts and pieces in play. But I'd be remiss if I didn't mention telling a great story as well.
I think that is great, and it gives people a reason to, I guess, get invested in the first place, or why should they get involved, or how to. So I think that's super, super important. Is there a time for you that you think that, or you see, or you even advise your clients that debt is smarter than equity? Like, what kind of scenarios do you see, or would you see that kind of situation?
Again, if their financials are pretty stable, they show good EBITDA, good revenue, then, and they're very good at their industry and their vertical, then I would say go toward debt. Again, if they're looking for a partner in that industry, and that partner has a strong foothold in that industry and is able to be a value add to them, because again, I don't want to make it seem like it's only one way, right? So that partner is a good value add to them, then that's where equity makes sense, right? But if they're very good at what they do, you might look at Cox Communications as an example of this, which is a $15 billion, or it might be more now, private company. They're Cox Communication, Cox Enterprises, and Auto Trader. It's a conglomerate, but they're a private company, and I'm sure when they need to, they take on debt, but then they're very well ran. They have a lot of great assets, and that's when, even on the small and medium size, I think that scales down, to the same model, right? So if you've got great asset position, if you're got great EBITDA, then I would say move more toward the dead side, and a little risk isn't bad as long as it's calculated risk. Right. And you can absorb it, and you've got great revenue, then I would say stay with the debt, and if you don't need to go and give away some of your company, then don't. So and of course, if your credit is good as well.
Gotcha. It's an important key factor to a lot of that, and ironically, was like I said, a big part of what I do is talk to clients about getting that credit situation straight, or kind of getting their business set up to where their business is sound, and that they're doing things not in their person. They're acquiring, doing things under the name of that business and not for personally. And it kind of leads me to my next question about documentation. And so, like, in your opinion, what documentation should every serious founder already have prepared?
So, so I'll give a disclaimer. So I'm not a lawyer, right? So, but I work with a lot of lawyers. I work with lawyers that are very good at structuring up organizations. That's where I see a lot of people initially go wrong. In terms of the industry that they're in, knowing how to structure it up, be it a S Corp, C Corp, LLC, sometimes a holding company. Sometimes you may, have entities, and you may need a primary entity and other companies underneath that, right? That's where a good corporate lawyer would help. I could advise, but that is not what I do. You would need a corporate lawyer to be able to do that for you. And I work with a lot of them that are able to do that, very good law firms, as well if you're going to issue shares. And so there's regulations in the SEC regulations, FINRA regulations that are needed, and so we have to work with accredited people for that, that carry Series 79 and different things of that nature, as well as potentially lawyers that work in that area as well. Again, working to see, from a business credit standpoint, I don't think a lot of times when the small and medium sized, people are looking at their own personal credit, but there's a lot of business credit, and then there's ways that business credit is positioned. And again, working with people who have a little more knowledge base in that to be able to get you the right type of loans for the right type of business,
Right.
either based off of credit assets or billables.
Right.
And so again, those are, to me, you have to have a team. You have to have a team of experts and advisors. If I would make one delineation between enterprise and SMB, is that enterprise is always surrounded by advisors or subject matter experts, as is commonly said in the enterprise space. And with the SMB, you don't have it as much, and I understand why. But you may not necessarily need to keep those people, in-house all the time.
Right. But you need them as
you need
advisors.
to start developing those relationships and bringing those people in. I'll quote Henry Ford. Henry Ford said, "I don't need to know how to do everything. I press a button and the expert comes in." So you need to be able to develop those relationships so when you need those people or those subject matter experts, they are there, and available to be able to help you when you're ready for that event.
I think that's really, really good sage wisdom and advice. And so if a business was out there and they wanted to double their valuation quickly, like let's say in 24 months, what would be something that you would tell them that they would focus on or should focus on?
Valuation, credit rating, Dun & Bradstreet, or whatever else. Make sure that their cash flow is positive. Market analysis, and again, go out and know your market. Know who you want to target you, right? So I think that's a big thing, is that a lot of people, when they're ready to sell their business, they're like, okay, I'm ready to sell. But again, it's like going into the dating market, right? If you're going into the dating market, are you going to go to the club where, at this point in your life, is that really the right place to go find a date, right? Or are you going to go to, maybe an environment where you're going to find somebody who's a little more in line with where you are in your career, your life, and that sort of thing. So again, you have to find that market. And I'll come up with an example for this, I guess, maybe. If you're a business case.
I'm sorry. Please hold that, because I think that.
Are we short on time?
We are running to. Did Byron go get the other? Did somebody come?
Yes, I'm gonna have him.
No, I'm saying
give him the release.
I think. Okay, so he's getting it together. Okay, I'm sorry. I'm sorry. Okay.
Okay, I'll shorten it to this answer. Let me know when I'm ready.
I'm sorry. Yep. So we're.
There should be.
I'm sorry. I apologize. For
No,
that,
it's okay.
So we are kind of close to the end. We probably got another 5 or 10 minutes. We're probably gonna.
Okay.
I got one last question for you, but you wanted to finish that.
Yeah, let me just finish that. I'll shorten it.
Okay.
Okay. Let me know when.
Okay.
5 seconds. Okay.
So go to an investment bank or private equity event. And don't go there to sell your business. Just go there where they may look to invest. We'll use the HVAC as another example. And just start looking online, and find an event where investment bankers or private equity is going to be, and look at what they're investing into, look what they're buying. And then start, getting a feel for that, take that home, and then start looking and seeing, does that match your portfolio? Does that match your offering? So that's what I would suggest.
And you know what, that kind of dovetails perfect in my last question for you, and that's if you were kind of looking into your crystal ball there and saying what industries right now are currently undervalued but poised for growth?
Well, of course, AI, that's always a big topic right now, but a lot of people don't know exactly what to do with it or where it's going. A lot of development. So that level of technology, fintech, Another big area of technology. Again, I'll get back to the more analog things, HVAC, as well as lawn care, or obviously large scale lawn care. A lot of private equity are buying that. A lot of those type of services. A lot of garages, a lot of mechanic areas. I'm starting to see private equity position for that. Medical, medical is huge right now, especially innovation. Military. I've got some good contacts in the DoD, and military innovation, especially around AI, is very big right now. So any of those industries, I try to kind of give a good
good
balance.
product mix.
Right, mix.
So yeah, as we're kind of wrapping up here, I'm going to go our closing. I'm going to go into our Mind Your Minute segment. So most businesses are really built to survive. There very few are built to be acquired, and so even fewer are built to endure. This week, if you're, I want you to look at your company through an investor's lens. This is some of the stuff Alan's sharing with us. Would you fund you? If not, you don't have a growth problem, you have a structure problem. So look into that. I think this was great advice that you had, Alan. And Alan, so this is here. So what's one piece of advice you would give a founder who wants to build something truly durable, like something that's going to last and something that somebody would want to acquire? What's one piece of advice you would give them? We do this in like 60 seconds. You guys,
Duplicate. Find a successful model and duplicate.
Okay.
The most sincerest form of flattery is duplication, right? Is copying. And I think a lot of people think they have to create that from the ground up, right? How many different ways can you do chicken? Well, Kane showed us you can do it in a different way, right, than Zaxby's or Chick-fil-A or whatever the case may be. You may have a unique twist, or it may be in a unique vertical or a unique market, but find a successful model that is durable, that is tested, duplicate it, and it just may be unique for that particular market that you want to serve. So you don't have to reinvent the wheel.
Wow, that's a great thing. So today's conversations make some things very, very clear. And so capital isn't just about money, it's about discipline, positioning yourself, and execution. So if you want to be respected by investors, you must build like an institution. That's one of the things you've been drilling out there. So I want to say thank you for bringing clarity to space, and that too many founders sometimes misunderstand. So Alan, it has been an absolute pleasure.
Likewise, Max. Thank you.
The show today. And so for our listeners who want to learn more about capital, control, and exit, where can they find you online?
www.volsonholdings.com. Also, I'm on LinkedIn, and Alan Amun, Volson Holdings, is also there as well. Reach out. Definitely strategic advisory, cap raise, strategic partnerships. We look to be able to provide and serve all of those areas.
Wonderful. Again, thanks again for sharing that and sharing how people can get in touch with you. And for all of you tuning in, if you want to keep up with me, Max Fortune, stay connected with the Mind Your Business podcast. You can find me on all social media platforms at Mind Your Biz Expert, as well as on YouTube and all major podcast platforms. So again, be sure to subscribe, follow, and keep the conversation going. We'd love to hear from you. Submit your ideas for show segments. Engage with our community. Let's continue to build it together. So until next time, stay sharp, stay focused, and always mind your business. See you next time.